On this week's episode of Industry Relations, we solve the home affordability problem with CEO Rob Chrane of Down Payment Resources. This is Industry Relations, a podcast that's at the intersection of real estate and technology from an insider's perspective, with Rob Hahn and Greg Robertson.
Hi, everybody, and welcome to another episode of Industry Relations with Rob and Greg. This is your co-host, the Notorious Rob Hahn, and I have my other co-host, Greg Robertson, who can be joining us right now. There you are.
Hola, Rob. How are you, man?
Hola. Hola, Greg.
This is getting to be pretty consistent, man. I'm kind of proud of us here.
I'm kind of proud of us, too. I'm proud of you.
Every week, right? Yeah.
I'm proud of you because, you're the one with a real job, unlike
working for the man.
Those of us who wake up unemployed every day.
And a hustle.
The hustle, baby. But I'm kind of excited about our conversation today because we've been talking about wanting to do something around housing affordability. It's kind of one of those background topics that comes up in like just about every one of our conversations, I feel, with what's going on. And it's a little nutty. I've been writing a ton about millennial home ownership rate is below 50%. We're headed towards renter nation, and I don't know if you're seeing anything like that with some of the things you guys are working on, like CMAs, like the volume of CMA, volume of transactions,
well, definitely the volume of doing it.
Yeah,
the volume of CMAs are going up, and I think that's a little bit more of a use case of using CMAs to generate leads are up there. But I think home ownership, affordability is a great topic. I wrote about this a long time ago, but there was something, I think it was A16Z, those guys,
A16Z,
had put out about how, there was this inherent thing where the way that the financial institutions work towards mortgage is like either Wall Street won or Main Street won, right? It was that was the cyclical thing. And nothing was more the case than you could see back in the Great Recession, right? But you know, there are some fintech models out there where like maybe that, the homeowner and the lender can both be co-owners, and therefore they're tied to each other. So when the equity goes up, they both win. And if something else happens, they're both down, right? So it's not this, us or them thing, right? And then there's just the nature of home ownership. Right now, and I think things are changing a little bit, is that you either rent and have no responsibility, no equity, or no anything, or you own and it's all on you, baby. Right. So I think that there's different ways and different models out there that are ripe for disruption, for lack of a better word, to help many people in different ways.
And we know, like, one of the challenges with like millennials, younger buyers, right, the first time home buyers is, so there's a study, I don't want to share it or anything, but people could find that on realestatewitch.com. This was quoted recently, where they did a survey of millennials, right? And one of the topics they talked about was like, what's preventing you, from buying a house right now? And 59% said market is too competitive, 56% homes are too expensive, 52% saving for a down payment, right? And that's a major topic because millennials with their student loans and everything else, like down payment is a real issue. It's a real barrier, which is why we have a special guest with us today to kind of talk us through that. Let's bring on Mr. Rob Chrane, who is the CEO of Down Payment Assistance. Rob, how are you?
I'm great, Rob. Greg, good to see you both.
Welcome.
Welcome, and thanks for joining us for what I actually think is a real important conversation, right? That even within the industry, I'm not sure how many brokers and agents really understand about down payment assistance, those programs that might be available. So really happy to have you here to talk us through. Why don't we just get started with just a brief intro? Just tell us a little about your company and yourself and how you ended up in this crazy industry of ours.
Yeah, that's a long story. I'll try to give you the elevator version. And first of all, thank you for having me. I was really excited. I think it was maybe your first industry relations podcast this year, and at the end of it, you guys were talking about topics you wanted to cover this year, and Rob, you brought up affordability, and I fired off an email to Greg saying, hey, here's some ideas, so thank you for having me, and thank you for talking about this subject, because it is important, and it's a crisis. It really is.
That's right.
And it's a growing crisis. It's been growing a while, and then it's just like COVID accelerated everything. This is one more thing that that COVID accelerated is the crisis around home ownership and affordability. So my background, I've always been in this crazy business in one form or another. And before that, I was a roadie for a rock and roll band. So after I decided to settle down, I was looking for something that was almost as crazy, but maybe a little more respectable. And I got into real estate. And I was a agent listing and selling properties for about 4 years, then a broker for about 10 years. Went to the mortgage industry for about 20 years, so I've already dated myself now. But so as I wasn't. Well, you're entrepreneurial if you're in the real estate mortgage business, but not a true entrepreneur, not a tech startup type entrepreneur. That wasn't my background. So, but one thing I did know from being in the business was that there's all this money out there to help people get into homes with down payment assistance. And as a practitioner, even when you're working your local market, there are usually dozens of programs, and who can keep up with it? They're from different kinds of agencies, different rules. It was just messy. And I kept thinking, there's got to be a better way to do this. And then as the internet became the place to go to get information, especially real estate, then I really thought, there's an opportunity here to at least get this stuff organized, make it easier to find. And but I had no intent. This was just something I thought somebody needed to do. I had no intention whatsoever. I didn't ever see myself doing that. But be careful what you wish for. If you say something enough time, it may come true, or at least somebody will say, "Well, go do it." And the circumstances just happened to work out the way they did, and here we are. And it's been fun. I mean, it's been. It's just been an incredible ride, and you guys know what it's like. Yep. Being having a startup and then building a company. So that was my background. That's how we got started in this. I just wanted to connect people with hard to find resources to help them get into homes, but also to help real estate agents, brokers, and lenders make that whole process easier. So
how long have you guys been around doing this sort of down payment assistance work?
We started in 2008. In fact, in a couple of weeks will be our 14th anniversary. Oh, wow. And by the way, happy anniversary, Greg. You got
That's right. Happy anniversary,
15 years, Vendor Alley. I don't know what I would have done without it.
Isn't it? Yeah, good.
Wait, so 15 years, so that's 2007. 7? Damn, you predate me by like 2 years. You beat me. Because I started in 2009.
Did you have a blog back then?
So I couldn't blog when I was at Realogy, right? Okay. Yeah, that's why I couldn't start until 2009, until after I quit. But anyway, back to So you've seen the market sort of really come and go, and let's talk a little bit about that affordability getting worse. Like, what's your take? Do you have any? Like, what are you seeing in terms of that, the affordability? Like, how bad has it gotten? Because you mentioned COVID accelerated the trends. So trends are already towards it becoming more and more difficult. Like, just what's the magnitude of that problem?
Yeah, I don't know how to say it or put it on a rating scale, but it's serious. I mean, the as you said, the home ownership rate has gone down. When I started this in 2008, that was right before the housing crash, the mortgage meltdown, subprime crisis, whatever you want to call it. That all started. In fact, our business plan, the primary market was to be lenders and the GSEs, Fannie and Freddie. And at a meeting, my first sales call was with Fannie Mae, and they were excited. I was excited. And a couple months later, we had the meltdown and couldn't find any of those people. So that's, but that's need is the mother of invention. And we had a secondary market planned once we got established with lenders, and that was the real estate point of sale. So we just did the classic startup pivot, and in 2009 started marketing this to multiple listing services, and went to my first CMLS conference in North Lake Tahoe in 2009. And the idea behind that is that everybody starts their home search online. Nobody knows about these programs, but what better place to put it than somebody's looking at a listing, they get interested, they look at the listing details page. Why not be able to tell them, hey, this home is eligible for down payment assistance, see if you are. And so that seemed to make sense to me. We started talking to MLSs and made sense to some MLSs, and we got started from there. Since then, we do have a very robust sales channel with lenders, and that's growing fast. Greg, I know you talk about the TAM for MLSs.
Yeah.
And, there's for the reasons you've explained before, there are limitations on that. With lenders, the TAM is a lot bigger, but it's a natural fit with lenders.
So roughly, like, how many people are we talking about that's receiving this assistance every year? Yeah,
so we can make an educated guess. It's not tracked real closely, but I would say 10 to 15%, probably a little bit more, but 10 to 15%.
So we're talking 600,000 purchases, because there's roughly 6 million, right? So somewhere between 600,000 and 800,000 purchases are down payment assistance. So are these all government programs that we're talking about here? I mean,
mostly. I mean, there are, financial institutions have some proprietary programs. Right now, what we keep in our database are all the government, quasi-government programs, nonprofits. But one thing I want to point out, too, about that number, that 10 or 15%, we did some research with the Urban Institute, and we analyzed HMDA data. We did it 2 years running, 2017, 2018. And the purpose of it was to say how many home buyers are actually eligible for down payment assistance. So what's the gap between who's getting it and who could get it? And we looked at the 31 largest MSAs, and we found for all mortgage types, so meaning conventional, FHA, VA, USDA, for all mortgage types, 36% of the borrowers for those years were eligible for down payment assistance.
That's crazy.
And we were looking only at owner-occupied purchase transactions. But if you break out FHA, because that's where most of the down payment assistance happens.
Right.
You break out FHA in some of those markets, it was 60, 65, 70, 75% of FHA borrowers were eligible. So their numbers, they say about 15% of their purchase loans have DPA. They actually say 40%, but the rest of that is, they call it DPA, but it's a family, gifted DPAs. Of the DPA that DPA with FHA loans is about 15%. So if 15% of FHA borrowers are getting it and 60 or 70% are eligible, that's a huge gap.
Why do you think that is?
I think
probably, right? They just don't know it's out there, right?
Exactly. And, back to the, not to skip around too much, but, we'll talk more about inventory, because that's certainly a huge part of what's driving this. And, there's no denying that inventory is a huge issue. But what I can talk about more is, what sort of things can we control? And one of the things we can control, and I think an issue almost on par with inventory, is what Greg just said. It's lack of awareness. And there are things that can be done about that. I mean, there's plenty of money out there, and people don't know about it. If you don't know about it, you can't ask for help. And then along with it, you've got some other, let's just say, disincentives for maybe participating in these programs, whether you're a lender, whether you're a real estate agent. So, I think that's the heart of it. And the good news is that's something that can be fixed.
So I guess, the first thought that comes to mind is, and I'm talking to like an economist, I'm going to say in the next couple of weeks about this, but there's some criticism as to some of these sort of demand boosters, right? Whether it's down payment assistance, whether it's subsidized interest rates. There are some folks who feel like, look, we actually would have a much healthier market. We would actually have more home ownership if we got rid of a lot of these demand boosters, because that would then force home prices to come down, right? And, in the last 2 years, home prices are up like 18, 19% a year. It's just crazy home price gains. It almost does, like, there is a point to be made. Like, I don't know how much down payment assistance are, but you just can't keep up with prices that are going up 20% a year, right? So is there an argument to be made that maybe the solution here is to actually get rid of all DPA, all demand boosters, get rid of 30-year mortgage, like let the market work, and we'll actually have more home affordability? Like, what are your thoughts around that argument?
Yeah, so I understand the point. I've certainly heard the argument a lot.
Yeah.
I look at it, what's the alternative? And from a social standpoint, home ownership is something that's important. It's important to society. It's important to, at the community level, the neighborhood level, the family level. You look at the outcomes, health outcomes, education outcomes, economic, economic benefits, that come by being a homeowner. And you also look at the widening wealth gap.
Sure.
And the difference, the haves and the have-nots, and that keeps widening. And so much of that is driven by household wealth. Studies show that about the non-homeowners, the average net worth is $25,000, and for homeowners, it's 10 times that or something like that. So, yeah, I understand the argument, but I think we could put ourselves in a worse situation if we reduce the rate of home ownership.
Right. So I think the argument, though, is that there's a difference in correlation and causation, right? In other words, like the savings rate, it could be correlation in the sense, and we heard this when the first real estate bubble burst, right? And people are like, all these ninja loans and all this, irresponsible lending. It's like, well, homeownership was high, but it just wasn't, sustainable. And the thought was, maybe somebody who can't afford, who doesn't have the type of habits to save 10, 15, 20% down payment, maybe they shouldn't own a home. Obviously, there are arguments to be made on both sides of that, and I guess I'm just wondering, because I know you've heard this and you've been working in the down payment assist side for so long, so maybe it's a question about the type of demographics, right? The idea that if you can't save 10, 15, 20% down payment, you shouldn't own a home. You should just continue to rent and save more, just keep saving. What's the other side of that argument? Do you know what I mean?
Are you talking more on like MID type of stuff? That are you considering that like a kind of, a subsidy in a sense, or what? Are you talking about these kind of programs? Because I'm
talking about like the argument from the free market side. Yeah.
Right. But when you go back to some,
go ahead. Go ahead.
I think when you go back to some demographics, I think, we should identify things where that can help, as Rob says, kind of like even out things for sure.
So I think the argument from the free markets argument side, and again, I'm not, this is such a complicated topic. I don't know which side I fall on, right? Because, as you know, I'm an ANCAP. I hate government programs of all kinds. At the same time, I also can't deny we're just heading straight toward renter nation, right? And it's not good for society. I just wrote this post recently about like how in this pandemic times, I feel like the fact that I own a home gives me the security and stability that if I were renting, I wouldn't have, right? So I'm getting that. At the same time, the argument I think is, if it's not that responsible, hardworking savers can't afford to buy a home, the argument almost is, if you don't have the type of habits, right, that lead to home ownership, then maybe you shouldn't own a home. It's almost that kind of argument. And there's something a little bit heartless about that, right? Which I think is why we don't hear it very often, but it is something that gets made. And ultimately, this has to do with more the overall affordability picture, right? Because it's something that I've been talking about and I've been asking people a whole lot. Ultimately, can you have housing affordability without home prices going down?
Well, it also has to do with inventory too, though, or the right type of inventory.
Sure, right. But I'm saying if we double
mansions for the rich and don't, do some sort of like multifamily type of situations or affordable housing,
right.
it depends on, the product we put out, right? And sometimes it's, that has to be regulated because builders are not going to see the profits they would off of a certain type of home set, right? So you're right. It is complicated. It's complicated. It's
super complicated.
Well, no, yeah, it is. There's no question. I mean, it's overwhelming when you start digging into all this and look at all the causes, look at all the potential solutions. What are the obstacles? What are the hurdles to those solutions? But we need more housing stock. We do. That's what's going to impact, the affordability of housing, or
well, it's housing stock, but the right type of housing stock, right, Rob? I mean,
yeah. I mean, you got to have entry level, and that's part of the problem now, is that not only is the housing stock squeezed, but it's especially squeezed at the entry level. So that's disproportionately impacting first-time home buyers, the underserved communities, minorities, because they don't have big down payments. For a lot of reasons. One thing I'll go back to just a second ago, because Rob, you were talking about the subprime crisis and all the people, too many people got into homes they couldn't afford because of ninja loans and liar loans and liar loans and all that. I used to have a huge soapbox that I got on, because back then in that 2008, 2009, 2010, so there were people writing about they were brushing with a broad brush people who took out subprime loans and irresponsible, not loans that just weren't underwritten, basically, versus people who were got loans using down payment assistance. There's all kind of data now that shows that these borrowers and these loans perform on par with prime loans. So, and we could go into, we could spend an hour just talking about that. I don't want to beat that to death, but.
And then we'll bore everyone to tears because, the details of mortgage are not something.
Yeah, absolutely. But so the point is that the amount of down payment is not a predictor of loan performance.
Gotcha. Mm-hmm.
So if we accept that, for what it is, then, look at the inventory. Okay, well, one of the things that, and this is, I'm pretty simple-minded, so it took me a while to figure this out. In fact, I sent, Elliot Eisenberg, the bow tie economist. Yeah. I sent him an email this week. I said, Elliot, this is probably the dumbest question you've had in a while, but, we know there's an indisputable shortage of housing stock, of inventory for sale. But we sold almost 7 million homes last year. Mm-hmm. Most homes in 15 years. It's almost, the record isn't much more than 7 million.
Yeah, it is. It is kind of like, it's a weird narrative.
There are people who say we don't have an inventory crisis, right? We know that. So,
yeah, I mean, and what he pointed out some things, which I won't get into the weeds, but he did say, first of all, by definition, a home that sells is a home that came on the market. What the issue is it's like the flywheel is out of control. It's the velocity of sales, so that at any given moment, there's not enough stock on the shelves.
Right on. Yeah.
But when you
so fast, it doesn't. The inventory goes so fast, it's not going to. Yeah. Interesting.
Yeah. So again, and so that's not to say it's not a problem, but the question I gotten the most the last year or so is because of this market, the lack of inventory, the all cash buyers, it's so hyper competitive. Is it even worth it for a first time home buyer who needs low down payment loan like FHA or 97% conventional, maybe needs down payment assistance? Is it even worth it for them to go out and look for a home? Will they even be able to buy a home successfully? If, we know that, sellers obviously are going to gravitate towards what they think is the deal, the offer, not only the best price, but what's going to close. I don't want, maybe I don't want to have an FHA, a contract contingent on FHA, because what if the appraisal comes in low? What if the appraiser says I have to make repairs as a seller? Yeah. And as a result, a lot of agents are advising buyers not to present FHA, VA contracts, USDA contracts, government loans. So yeah, that's all real. And yet these housing agencies, these program providers are doing a good business. They did a good business in 2020. They did a good business last year. They're doing a good business this year. So somehow people are still getting offers accepted and still buying homes with FHA loans and with down payment assistance.
Okay.
It's not easy. So, and this is something that, like I said, I get the question all the time. It makes me ask people that are in the trenches, how is this happening? Because again, it doesn't add up. It doesn't compute, right?
I think you hear a lot of stories from the coastal cities about all this wackiness going on, but there's still a lot of country, right, out there that's a bit more normal than, your Southern Californias and your Washingtons and, everything else, right? So I think, but a lot of the stories focus upon some of the craziness out there in these coastal type of cities, right?
Yeah.
But there's, so that makes a little sense to me. One question I had is you talked about, and maybe you just rattled one off, but I think you had said there's some disincentives for agents or lenders to offer these types of programs beyond what you just talked about, where they don't think that, an agent doesn't think that, those types of loans will get up higher in a place in a bidding war. What other disincentives are you talking about? Maybe I'm using the wrong word, of why lenders or agents kind of shy away from these down payment resources?
Yeah. So, and I'll separate agents and lenders because it's a little bit different. There's some commonalities, but first of all, it does add a layer of complexity to a transaction.
Okay.
And that complexity starts with finding knowing that programs are out there, finding them. It's a Rubik's Cube trying to line up is the property and the borrower and the program, what's going to fit. And of course, that's what we do is we automate that process. That's a different story. But so it's a layer of complexity, but there are also some things, myths and misperceptions that we debunk all the time. So for one, people, I would say this is agents definitely and lenders to some degree, people who look at this as a very small niche and not an unprofitable niche. In other words, you talk about down payment assistance and people envision, very low cost homes, maybe in distressed neighborhoods, and very low income households, that these programs are only for very low income households. So, and yet it's what it is. It's not a tiny niche. It's a significant market segment, and it's growing significantly. The need for it is growing. So that's an issue. The complexity is an issue. And then there are these things like, well, is this going to slow down my transaction? And I'm sure there's times where it has slowed down the transaction, but so many of these things, these are unknowns. If you don't deal in this business on a regular basis, the fear of the unknown, and it always seems worse than what we think it really is. So, I'm sorry.
No, go ahead.
I was just to say, we've been doing this long enough. We don't get complaints, saying that these transactions are slowing us down. And, the research we've done shows that there's very little difference, if any. Again, that's, you can't say 100% that it's just as fast as doing a conventional loan. But when we talk with agents who are doing this successfully, even in tough, in competitive markets, there are just a couple of common elements, blocking and tackling, not any, flashy silver bullets. It's education, patience, and persistence. So if, agents that work with first-time home buyers, especially agents that want to help people with these programs, they educate their client before they start working with them, or as they start working with them. And that education has to do with, look, here's the reality. There are going to be homes coming on the market that you're not going to have a chance to buy. That's just, and here's why. So here's what we're going to do. You know, they help them adjust their expectations. They say we're gonna have to look for homes that have been on the market a little while. We're probably going to have to go outside the area you originally wanted to buy in. And so, you know, that goes back to what you were saying, Greg. I mean, you have the high cost markets, but even, you know, even in cities, you know, near the heart of a city, it's going to be more expensive. You go further out and it's less expensive. So people are going further out. Yes, it's taken them. Maybe they're going to have to make multiple offers before they get one accepted. The other part of the education that the buyer's agent is doing is with the seller and or the listing agent, and to be able to convince them that, look, I know what I'm doing. I do this all the time. This is why you don't have to worry. Here, talk to my lender. I work with lenders who do these things every day. They're good at it. They know how they get it done. That's not going to win it. That's not going to win the day every time. But that's the kind of stuff that people tell us. And, you know, and we hear it in all kinds of markets, including this kind of market. So,
all right. So, I mean, I guess I want to talk a little bit about futurism a bit, right, in terms of solutions. I mean, am I crazy in thinking that down payment assistance actually just fits right in with power buyer models? Right, meaning, you know, like the like buy with open door, or fly. I don't know if Fly Homes does it anymore, but you know, like where these companies go in and pay cash on behalf of a buyer, right?
Well, that's called cash. That's not a down payment at all. That's
exactly
all the money.
But what I mean is, like, doesn't this make sense? In other words, open door goes in, pays cash, right? Sellers out, listing agents out. They don't have to worry about, you know, is this going to close on time, etc. And then you negotiate the down payment assistance mortgage afterwards, right? So that it only involves the buyer, not the seller, if that makes sense.
Yeah, no, it does. And so, and there are companies that actually do that. And there are companies that, I don't know if you've heard of a company called Landis, L-A-N-D-I-S. Yeah, check into them. They're not in every market yet. They're a very, very well-funded startup. And their mission is to help, you know, low to moderate income people get ready to be homeowners, and you know, all of these, the motivation behind this is not like the subprime deal where let's shoehorn as many people as we can into homes. Mm-hmm. It's how can we make people be successful homeowners? How can we make sure it's sustainable?
Okay.
So
given that, like, are you guys in talks with Open Door or some of these power buyer guys? Are they interested in this, implementing this part of their flow as part of their process?
It's a little bit nuanced there. The way I think about it, Rob, is that so once the buyer works with those guys or seller, it's more of the seller thing. I guess I get.
No, but the seller's just getting cash, so the seller doesn't care, right?
Right. So the power buyer. The issue is. But the issue is, like, aren't these down payment resources based upon the buyer? And if basically if the power buyer is now the person and they're not of Native American descent or whatever the reasons why they're going to get this down payment assistance, would it work in a post model of that? Right.
Well, yeah. So the way
ownership is different.
Yeah. What happens in the case of Landis? They buy the home, and they actually the person who's ultimately going to buy that home, they connect with Landis. They get pre-approved, basically underwritten for a mortgage, and you know they have to meet certain guidelines, not just prove and be underwritten to the point where they know that within a year or 18 months they will be able to get approved for a mortgage. So there's a lot of work that goes on the front end. Once Landis approves them and they have a budget, a set budget, the client goes out and finds a home. Landis buys it for all cash. Their client rents the home, like I said, for 12 or 18 months. and then they buy it when they're, as soon as they can get that mortgage. And I think they have, I think they get a 3% premium, 3% a year. Landis gets 3% a year. So in other words, in 12 months, that buyer is going to pay 3% more than what Landis paid for it.
Which in this market, when a home price going up 19%, is Landis
awesome
taking a
deal.
loss. Yeah, that's a great deal. No, but it's that, right? It's the main issue is the bridge loan models. You actually have to be a homeowner first so that they could list and sell your house. I'm saying this is just straightforward. First-time home buyer. They don't own a house today. They come in, and I think Landis is the first company I've heard doing something like this. I want to hear like Open Door and, OfferPad and some of these other power buyers that are out there are looking at stuff like this, right? Because it would eliminate one of the complications with the seller saying, well, I don't want to take an FHA with a, buyer assistance because that's going to fall apart. It's like, no. As far as you're concerned, you're just getting paid cash, right? And you're getting taken right out.
Yeah.
And I just, so that's one. The second thing that I was wondering about was, how do we, so maybe, like you mentioned this before, Rob, where you said some of the studies have shown that these, home buyer, down payment assistance buyers, the mortgage is at the same quality as prime. Because there was a study, done right after the sort of collapse that I remember reading. It's a little bit dated, that talked about the biggest predictor of foreclosure was the amount of equity that the buyer had, right? So obviously, if you have a low equity owner and, it goes underwater, they're just going to walk, right? Are you showing that that's just not the case? Like, or are the programs engineered in such a way that that's not an issue? Like, talk to me about that.
Yeah, JP Morgan Chase a couple of years ago did a study, so much more recent than what you're talking about or the time frame you're talking about. I remember seeing some of those back then. I don't know, I don't remember the details, so I don't know if it's the exact same one, that you're talking about, but definitely saw that. There's a lot of ways you can manipulate the numbers to prove a point. And I'm not saying the study you read was a lie, but
it was just old. I mean, I was at least 10 years old, right?
Yeah, but
you can still have a study that says that people with low equity are not good, people, or they are worse loans. But hold on. But you can also have a study that says people that use the down payment resources tools actually were good ones, right? I mean, they fall in that category of low, but maybe because they went through that process, it shows some sort of gumption, right, or that they
want to be homeowners,
work to make that happen. That because of that behavior, they became better customers to mortgage companies, right? So I don't think they're mutually exclusive.
You're right. So some specifics around that. Almost all of these programs require a pre-purchase counseling certified education program. So there's some, they have to do that. Mm-hmm. The loans are underwritten, which of course that was not happening with the subprime loans and the ninja loans and all that, but they weren't underwritten. Nobody had to have an income or didn't have to have assets. And so they have the education, the loans are carefully underwritten. And then on the loans that, some of the loans that people are getting when they're getting DPA, like through state housing finance agencies, those agencies are also offering the first mortgage. Now, the lenders who participate with them are the ones, making the mortgage. The state HFA is buying it. But a really critical piece is that those first mortgages that are purchased by state housing finance agencies is the servicing. So by that I mean is, if on my mortgage, if I missed a payment, I might not hear from the servicer I could miss maybe 2 or 3 payments before they'd be looking for me. With these agencies and these loans, they're on the phone with people before it's 30 days late. And if you have low equity, if you're, moderate income, if you get behind 60, 90 days, you're probably not going to catch up. So that's why they're much more proactive in terms of...
Yeah, but that doesn't solve the jingle mail problem, right? In other words, if you have low equity and your house goes underwater, The study that I have to go find it, maybe. What it showed was people just said they just walk away. Right?
A lot of rich people walked away too, Rob, right? A lot of rich people walked away too. A lot of rich people walked away too.
No, what I mean is, and it makes sense. If you have 20% down payment, you're much less likely to walk away, right? Because you're losing a huge amount of your equity. If you have 2% down payment or 2% equity, whatever, it's only 2%, right? It's that. And I think the risk is not that they're good borrowers, is that if the market turns, right, and you're underwater, or you don't have as much equity, you get into trouble, you just walk. Whereas the people who have equity, they bend over backwards. You know, they sell the other assets to make their mortgage payments. It just makes sense, right? Yeah, so that's the foreclosure risk problem. Yeah,
I'll have to dig out for you JP Morgan Chase Institute study that was done a couple of years ago, where they actually totally refuted that.
Okay, cool. All right.
So I'll dig that out. Maybe you can put it in the show notes for anybody who wants to read that.
Yeah, that'd be cool. So like that's the futurism thing. I mean, again, I think we're almost an hour already, so there's some things that are coming out. I guess, so let me wrap up kind of like this way, Rob. What are you looking forward to, given the market and the situation we're in right now?
And how can people how can we further this education for the market, right? You work with MLSs, and tell us about that as well.
Yeah. So if I was king, I would have the industry double down on training on this. First of all, training, certifications, things like that. And I know some the associations have some training, but not nearly enough. To overcome these myths and misperceptions, to keep up with the programs, to understand how they work. And I'm not talking about trying to make a real estate agent a subject matter expert. They don't need to do that. They do need to have some good lending partners, and that's where we see the most success is if our tools are available to real estate agents or brokers through their MLS, the ones that make the most out of it. It's a conversation starter. It's a compelling offer to tell somebody we might be able to help you with a down payment. They don't have to be experts in it. They just have to know that they've got, one or two or three lenders, that loan officers who can do a good job with these programs, and say, let me introduce you to my loan officer. They're going to explain it to you. And then the loan officer will, take them by the hand, walk them through it, and get the deal done neat and clean. So, education. Another thing that's this sounds such a blinding flash of the obvious, but I don't for the life of me, I don't understand why the housing industry, and I don't mean just the real estate industry, but the trade orgs, NAR, MBA, home builders, the government, Fannie Mae, Freddie Mac, HUD, CMLS, the damn PSAs, public service announcements. And the reason I say that, it sounds, Craig's trying not to laugh, but seriously, think about 2009, 2010, the first-time home buyer tax credit. Remember that?
Mm-hmm.
Yeah.
Everybody in the country knew about that, right? Today, hardly anybody still knows about down payment assistance. But why did everybody know about it back then? Because the industry and the government, there was they used their collective megaphone and had a unified, simple message. And it was hammered home, and everybody knew about it. And the program was effective. It was so successful, they extended. It was supposed to be 1 year. They extended it to 2 years. So, it just getting people aware that these programs are out there is just, that's the low-hanging fruit. We can't create housing stock overnight. That's going to take time, but we can. There are a lot of people out there that could become homeowners that are mortgage ready. There are 37 million renters, 45 years and younger, that are mortgage ready today.
And I know that a lot of times. Go ahead. Sorry, finish.
No, I'm sorry. I was just going to say, and so many of them don't know it. there's all kinds of surveys out there and research showing that they grossly overestimate the size of the down payment they need. So they've self-selected themselves out of the market. They're not even looking. Some of them maybe, there's reasons why they don't want to be homeowners anyway. That's fine. But, there's, and then, you look at, I was talking about this study we did with 31 of the largest metro areas, is another part of that study, which we weren't involved in this other part, but in those 31 markets, 6.3 million Blacks and Hispanics were mortgage ready. And so anyway, there's all kinds of stats about, how many mortgage ready people there are out there.
And then what I remember talking to Ishai from Rental Beast, and he was talking about, he had a big number for there is, $40 billion in referral fees that realtors can make if they tap into the rental market, right? Is there a big number for down payment? I mean, how much assistance and how much money is available in down payment assistance programs out there? I mean, do you guys have a figure like that in your industry?
No, and the reason is because these programs are funded by different mechanisms. So you have bond funding, you have government funding, HUD, community development block grants, home programs, and then you have TBA programs, which are basically, it's like a conventional.
It's got to have a B in front of it, though, right? It's got to have a B in front of it.
Yeah. I mean, I was just looking at something from Maricopa County, Arizona, so Phoenix area. One agency. Now there are other, one program, one agency, $191 million last year of down payment help. Almost 25,000 home buyers they helped. Maricopa County, and there are more programs than that in Maricopa County, so there were more people.
So what do you think nationally? Are we talking like 10 billion, 100 billion? What are we looking at? And are there federal programs for this, or is it all state and local?
Well, most of the federal money is distributed at the local level.
Okay.
And that's why, the CBD,
the block grants,
CDBG, and home, they're local participating jurisdictions, whether housing finance agencies and municipalities. There are some programs that are available nationwide, and I know we don't have time to talk about this now, but there's new programs coming online. There's some really cool stuff going on.
Right. All right. So let me wrap by asking a question that might get you in trouble, or might not.
I'm sorry, we are dealing with a bad connection here.
Exactly. And maybe Greg and I will argue about it after. But given that we are talking about a problem that is getting worse and worse, right? Affordability is a major issue. It's getting worse and worse, like you said. Home prices are going up 20% a year, right? Would you support, let's say, a 10% surcharge on real estate commissions in order to fund down payment assistance?
Oh, Jesus.
Because that's $8 billion a year.
Well, that's, I hadn't thought about that. I don't think I'm ready to die on that hill. I mean, the thing is,
yeah, good for you.
No,
good call. I urge you not to.
but seriously, and like I said, I've been a real estate agent. I've been a mortgage lender. I know how hard you work for your deals, and I know how I would have felt if somebody put a surcharge on my income.
Mm-hmm.
So that's why. But the other thing is, there's already plenty of money out there. There's more money out there than is being used, and a lot of it's being used, but there's still. So money isn't the problem. Education, awareness, and inventory is the problem. And we need to create more inventory, and that's a, Lord knows, I don't know how many industry podcasts that would stretch out, but
who knows? Maybe Greg and I will talk about that in our next thing. But I think that's a good place to wrap. Not going to commit to a career suicide statement. So I applaud you.
Pass the test, Rob. You passed the
test. So if people want to find you, Rob, where would they go?
Well, you could go to our website, downpaymentresource.com. And instead of trying to remember my email address, you could send it to info@downpaymentresource.com, or you can send it to rchrane@downpaymentresource.com. Chrane has an H in it, RCHRANE downpaymentresource.com. And I do, I invite listeners, anybody who's interested in this, who feels passionate about it or who has information and ideas. We love talking with people. I love to talk to people and share information. We've got a ton of data we're happy to share. We've got a team of seasoned experts. So I invite anybody who wants to talk more. Would love to do that. And,
and always a pleasure to talk. Always a pleasure to talk to you, Rob. You got one of those out there, such a good egg, and really coming from a place of doing really good work and good stuff for the industry. But thank you so much. And
it's a critical issue, so I'm really glad you're out there. So
well, thank you so much for having me. I really appreciate that, and I'm glad that you guys are talking about this because it is important. So I look forward to the continuing to listen to Industry Relations Podcast. I love it.
All right. Thank you, Rob.
All right.
Thanks, everybody.
Take care.
All right. Bye.